Hello everyone, I hope that you guys are doing great. Let's talk about a small concept of depreciation. Why is it charged within the accounts? Because whenever asked from the students, they always know how the depreciation is charged because it is one of the most easiest calculations within the field of accounting in itself. But when the students are asked the questions that why depreciation is actually charged within the statement of profit and loss, why not just buying an asset and expensing it all out in the statement of profit and loss? Why is it not allowed? Why depreciation is charged over the years the asset is used? This is a question that majority of the students who are currently studying any professional qualification or are in OA levels, they are unable to answer this question. But I'm going to simply explain this simple concept of depreciation charge in a few simple seconds so that you can understand this concept for the rest of your life and remember this concept as well. So let's take the example of a coffee machine that you are going to buy today, and you are going to use that coffee machine for over the next 4 years period to make the coffee first of all using that machine and then sell that coffee to the customers. In return, this means that you will be benefiting from this machine over the next 4 years while selling the coffees to the customers. So instead of expensing out the whole $20,000 in the year one's financial statement, what you should do is that because you will be benefiting from this machine over a 4 year period, the expense should also be divided into 4 years. That would be $20,000 divided by 4 is equal to $5,000 as an expense in every single year. So year one depreciation would be $5,000 using the formula we just derived. The year two expense would also be $5,000. But the main concern is that after when the machine has been charged a depreciation of $5,000 at the end of year one, or by using the machine for the whole first year, the net value of that machine now would be $15,000 because you bought it for 20. You minus the $5,000 depreciation charge, you get a remaining value of $15,000. In the year two, when you will be using that machine, again you will minus $5,000, and then you will have a remaining value of the machine in year three of only $10,000, and goes on and goes forth until the last year when you will be very close to scrapping out that machine or selling that machine. The net value of that machine would be zero in your accounts. That is the basic concept of depreciation. Well, now because we have understood the basic concept of depreciation, and the formula we just understood was known as the straight line basis formula of depreciation charge, which means that whatever is the life of the asset, you are going to use that asset for how many number of years should be the basis upon which you depreciate that asset. Some of the machines can be used for 10 years, some can be used for 20 years, and this simply means that whatever is the cost of the asset, you will divide it by the number of years the asset has its life, and then you charge that depreciation to statement of profit and loss, and every single year by the same amount that machine or that asset is going to lose its value. But now let's bring in the other technical area, that is reducing balance basis. Majority of the students again know what is reducing balance basis, where you just depreciate the machine based upon a certain percentage every single year. Now, why is reducing balance basis used? To understand this, you need to understand the difference between why is the straight line basis used and when is the reducing balance basis used. IS 16, the standard which is behind depreciation, states that when you think, or when a company or a business thinks that the first year, the second year, the third year, the fourth year, whatever the life of that machine is, every single year the business is going to use the machine in the same way. They are going to produce almost the same number of coffees every single year using that machine. This means the machine is being used under the same conditions every single year. Then the straight line basis must be used to depreciate that machine. But IS 16 also states that when a business thinks that in the first year the machine would be in very good condition, so the business is going to use that machine for a much larger amount of production run. In the second year, the machine is not going to be in very good condition. It is going to wear out and it will produce less coffees for the customer because now it is an old machine. In the third year, it will become even older. In the fourth year, it will become even older. If this is the case, that every single year the machine is wearing out and producing less and less. In the first year, the machine produced 1000 different coffees. In the second year, the machine only will produce 900 different coffees. The production run of that machine is lowering. The overall output from that machine, the economical benefit that the business would be getting from that machine over its life will reduce over its life every single year. Then reducing balance basis should be used. For example, the same concept, a machine of $20,000. Now the concept is that this machine would wear out every single year and would produce less coffees for us. So in the first year the machine would be used for higher amount. The machine would actually produce higher number of output. So in the first year, let's say 25% basic reducing balance percentage is used to depreciate this machine. We would get an answer of by calculating it, we would get an answer of 5,000. 20,000 multiplied by 25% is equal to 5,000 depreciation charge. So in the year one, the total depreciation charge is 5,000. Let's go towards year two. What is the remaining value of the machine? It is now 15,000. 15,000 multiplied by 20%, we would get a depreciation charge of 3,750. Now the first year depreciation charge was 5,000. In the second year the depreciation charge was 3,750. The reduction in the depreciation charge means that in the first year we got a higher economic output from the machine. In the second year the economic output reduced, hence the machine's depreciation charge has also reduced. Now move towards the third year. Again, using the same formula, you would get lower depreciation when compared to the second year. In the fourth year the depreciation would even reduce. Every single year the depreciation is reducing, giving an image to all the readers of the financial statements that the machine is now less useful for us. That is it.